Welcome, Sean Ridley from Kentucky. Great to have you here. Please
Oh,
tell more about you.
well, thanks so much. It's great being with you, and I've enjoyed our conversations leading up to today. I'm been in the wealth management, investment banking, private equity space for a long time, over 35 years, and got my start in Boston. Moved down to Louisville, Kentucky, 20, almost 30 years ago, and helped a company. I was recruited by a company that had 600 million in assets under management, recruited to 6.6 billion in 7 years, sold out to a nice big bank. And ended up years later starting a multifamily office called Atlas Brown. And we had, in a few years, over $1 billion. And that was very successful. And I had an inkling about what was going to happen in 2008, because when Bear Stearns money markets went off $1, I was like, "There's a real problem out there," and we weren't really equipped, meaning Atlas Brown, to do investment banking and private equity at that time. So I started Ridley Capital Group in 2009, and so we have some private proprietary funds. We do investment banking work, and obviously we sponsor, some individual companies, and do a lot of capital advising along those pathways.
And which trends are you seeing in the market at this moment?
Well, obviously AI is really big. I know you're into that, right? I think a lot of wealth management firms are mostly through the public markets, right? I think we don't get into the kind of short-term guessing games, but I suspect that it's really had a good inning or two, and I suspect that some of these valuations are a little toppy. So I think it'd be healthy for a pullback. Obviously, we see power gen, aerospace. We're following both those areas quite closely. And believe it or not, even though the United States has pulled back, as the current administration has pulled back from green energy and new kind of renewable energy sources, we see trends in that space globally that are very powerful and hopeful. So those are the kind of major trends we see right now.
And you dived with your company in the aerospace. Tell a little bit more about that.
So we have our tentacles out globally, and we're invited to meet with some folks who kind of are major tier one suppliers to the three big rocket companies here in the United States. And SpaceX being the biggest, most ambitious. NASA's announcement, I think it was Monday, how they're changing their mission more towards Mars, is interesting. But what's happened is a lot of suppliers aren't suited for, they don't have the capacity, they don't have the technology, they don't have the know-how to supply what's needed to build a rocket at the quality controls. Obviously, quality control is very important. And then secondly, in the time frame that people like Elon Musk and Jeff Bezos want that to occur. SpaceX is most ambitious. And we have come across a couple companies that can do that. And what they need is capital. They need capital advising. And they cannot just go and build capacity, because right now capacity is such that to build it, with permitting, finding land, building it, getting the equipment, it's at least 18 months before a product would get out the line. And so, for instance, SpaceX, their older rocket, I think they sent out one every I want to say about 40 hours this year. But their main rocket, they've only had 11 launches, and they want to produce one every 35 hours within the next 3 years.
Really?
Yes.
So they need a lot of material to build those rockets.
They do. And so this is actually an offshoot of the oil and gas industry, because if you think about oil and gas, they have those giant, very strong steel structures that go into the earth, plow into the earth, do all sorts of exploration, things like that. And those are the companies that tend to be right now, for the most part, I mean, I don't want to generalize so much, but they tend to be small to mid-sized companies that supply those companies. And there's a lot of them down in places like Houston, Texas, or Texas, Oklahoma, the United States. The energy markets aren't having a very good time right now, because President Trump is trying to get the prices down, which would control, the affordability, problem that he's facing right now. But some of these companies are transitioning into, aerospace, and it's the same thing, I think, but they don't have the tools to do that. And I'm talking about the physical tools, the laser, the robotics, the forging tools that are really required when you talk about aerospace. So those companies that are investing in those, in the, current technology are the ones that are winning business. We know suppliers that have so much business, they're trying to get it off to other people who are quote competitors just to satisfy the demand. And what we're really also saying is that that industry on the supply side is an elder industry. So meaning a lot of people in their late 60s, 70s, their kids don't want to take over the business and they kind of want to get out, right? And so there's a lot of opportunity on really, manifesting a strategy around the supply chain to these companies. So that's what we're exploring.
So you're exploring also to take over those companies from the elderly owners, which don't have follow-up or not the right follow-up.
Yeah. So what we do is we have found a couple anchor companies that we would supply the capital for them to figure out which companies are proper. Obviously, that's where we come in and help with the due diligence and things of that nature. But everyone seems to know everyone. Like a lot of industries, it's a little bit incestuous. So that's a good thing. So they know who's for sale, who's probably a good acquisition, who's big enough to handle it, and that's where we're coming in. So yes.
And then once you have acquired those companies, are you going to actively run them as well from your firm or not?
Yeah, that's a very good question. No, we don't get into the day-to-day operations. We have seen this before with venture capital firms, private equity firms. A lot of times, those folks they get too ingrained in the operations of the business, and it takes away from the flow, from the entrepreneurship of the actual management team that was running it prior to the investment. So we just take a board seat or two, and we are advisors, and we're there really we're capital allocators. So that's what we tend to focus on. Now, if there's a problem,
yes,
we have a lot of folks we can bring in to help them, but that's not our focus. Is not operations.
No, you really keep to the capital part.
Yes, yeah.
So next, besides SpaceX, is there another focus within your firm where you're at the moment working on?
Well, we do have. We tend to. Our history has been financial service and fintech, and there's a lot of exciting plays there because that's the industry in which we operate. So that's obviously something that's been, very strong for us. In fact, we invested in an AI company back in 2015, and we were ahead of the ball game. And it was focused on community banks and did really well. The space has gotten crowded. Valuations are a little toppy for us, but we do have a fair number of fintech companies. We have a private credit fund. Private credit is the big boys are having a problem right now, and I think there was a rush to private credit. We've been in private credit since 7 or 8 years now, and we tend to stay small. We're not in the billions of dollars. We don't want to be. We've been asked to go on national platforms, and we just thought that was going to be a mistake. Our credit is we don't use real estate as collateral. We only use things that could be converted into cash quite quickly. For example, in our world, bourbon barrels can be converted into cash quite quickly. They are very liquid. You can convert them into cash in a couple of weeks, especially in a place like Kentucky. Their price is very stable. If it has a little downturn, it's low single digits, but it generally over the last 25, 30 years has been nice low mid single digit growth, and we don't over leverage on that. So, and the other thing obviously is loan portfolios that we like, and we're very conservative on that. But we always can grab the loan portfolio if we ever had a problem. Now we haven't had a problem, so we're knocking some wood right now. But that area is also good. Now the other place that we're actually returning to our original roots. Remember in 2009 when I started Ridley Capital Group, real estate was very distressed. Banks were very distressed, and so we actually served as advisor to a lot of banks, put banks together, recapitalized them, brought in management. And one thing that we were able to do is cherry pick some nice properties, distressed real estate from the bank portfolios. We're seeing that same possibility now. So we're just launching our second distressed real estate fund. And we feel like our first one was fantastic. We feel like this next one's going to be really good as well because there's just so much real estate out there that's underperforming. And banks.
Sorry to interrupt you. I'm just curious. You say there's so much distressed properties out there, but how do you select them? And which challenge do you have by selecting? We want to hear the challenges challenges as well.
We have a challenge right now. We have something out on the West Coast. It's in bankruptcy. That's a problem. We have a couple folks on the team who are, who worked out in LA for a long time. So they got a lot of tentacles out there. Have this property, got it under contract for, forgive me, like 13, 14 million. And it's appraised, shovel ready because of entitlements and permits are all in place. It appraised for 64 million. We're having a problem because the bankruptcy court, is slow and we have other bidders and, we don't want to be a stalking horse, but we'll see how that comes. So that, when it goes into that deep, it gets much more challenging. The other thing that's challenging is when you go to a bank and you say, hey, let's look at your portfolio. They want to sell you everything. They want to sell you the stuff that really isn't quite good when we're just really trying to pick out some of the good stuff that we think is more anchor type investments. So I think I mentioned one time, one thing we really focus on is the return of your money first, as opposed to return on your money. And if you do that and you avoid losses in a portfolio, compound interest, the eighth wonder of the world really works for you. So that's what we try to do. So we never go in and just buy a bank's portfolio, but we have a lot of contacts in the regulatory arena and obviously in banking, in banking circles as well. So we're seeing a lot right now.
So you're basically trying to find the cherries at the banks and then you put them in your fund. Is there still availability in your fund?
We're just launching that. So we do have availability. We have monthly closings. We actually set up a subsidiary of Ridley Capital Group, so we call it OAI Capital, and OAI Capital is the sponsor of the fund. So yes, we do have availability. And there's information on our website, but we don't offer the fund documents or anything like that on the website because it's highly regulated, obviously. But there's an info button if someone wants to go to oaicapital.com.
Okay, thank you. And if you have a vision for the coming 6 to 12 months, what would you like to accomplish, not only with the fund, but with your company in general?
Well, that's an excellent question. So we'd like to, gain some traction. We've been a little busy on this distressed real estate fund and really get that into a nice position to, find what we're looking for, in the distressed real estate. We don't feel like this is a short-term problem in real estate. The second thing is really get the supply chain for SpaceX and Blue Origin, those type of companies off the ground, and power gen. They all kind of go hand in hand. Power gen, aerospace, and oil and gas. Believe it or not, oil and gas we don't expect to come back anytime soon. And continue with our credit fund in a way that we don't have any losses and keep finding good strong businesses, small medium businesses to help their growth, and that would be a good 6 to 9 months.
If you could solve one major challenge today in your company that it makes you accomplish the goal you just mentioned within 12 months, what would that be?
There's a couple characteristics that I look for in people, right? One is what's called high emotional quotient. And that's really important to me, is that people who understand the ebbs and flows of business and transactions and never get too emotional about them, right? It's super important. And our clients expect us to behave that way. But with that also comes a big dose of humility. And finding talented people is not that hard, but finding talented people who are, both feet on the ground, as they say in the Midwest, and have a nice kind of healthy humility about them is really our challenge all the time. And we're not in the, the money centers, even not that, it's only New York, but Chicago, they're a few hundred miles away. Atlanta's a few hundred miles away. Louisville's a mid-sized market. So I've grew up in Chicago, so I'm from big markets and moved here from Boston. But, so finding those type of people is one of our challenges.
Yes, finding the people who would be interested to work with you together.
Yeah. With the characteristics, characteristics we look for in our folks. So when we hire someone, they tend not to leave, which is we don't have turnover, which is nice.
That's really nice. You can really build a long-term relationship in the team.
Yeah, and our business lends itself to remote, right? A lot of people work in other cities and towns, whether it's Colorado or Texas or the Carolinas or Florida. So that's not a problem. But finding these people is our biggest challenge.
You think this is an industry-wide issue or not?
I think if people were honest, if managing partners were honest, that it's getting harder and harder. I have a couple friends who are neighbors who have VC firms, and one works for one of the biggest PE firms and the hedge funds in the world, just a couple doors down. And they say that finding that talent, that can come on up and understand, kind of what it takes in these transactions. Everyone knows they're complicated. So many people know how to do spreadsheets, right? It's not spreadsheet building. It's not that. It's kind of of three-part thinking, right? Of how this works, how you're going to integrate it into what you're trying to accomplish, and what are the risks involved. And the risk, assessment's super important, right? And that's why we see so many failed kind of big transactions out there that just don't work, right? And so that's I think if folks are honest, yes, that would be a number one problem: finding good people to kind of take these leading roles in these firms.
If we then go back to the beginning of our conversation, the trend is AI. You think AI could support in this, or in a way support the team? Or are you not exploring that at all in the company?
No, we use AI. I mean, AI is an incredibly powerful tool for us. I mean, it really is. And I mean, it saves so much time for us in terms of analysis, industry analysis, geopolitical analysis, macroeconomic analysis, and even finding people. AI is getting bigger and bigger, which is also a big problem in that we just don't require as many people as we used to, because we're utilizing AI, right? So, but you always need somebody to lead these transactions, right? And that's what I'm talking about, is people who can sit in the chair and think like the owner of that company, right? And think about what they're thinking about, like their hesitations, their worries, their day-to-day, challenges. And that's what AI can't. We haven't utilized AI that way yet, right? And I think that's more of a human touch.
I totally agree. AI is for the processes, and leadership is with a leader. That's with emotions.
Exactly. It's that human connection, which is still very, very important. And I think in all industries, right? And, when we hear doomsday, and this is another great conversation to have sometime, doomsday about AI and how it's going to just displace so many workers. I'm not so certain about that, because with every, we've seen the economy evolve. I think there's going to be less displacement and more opportunities than people suspect. To what degree, I can't speak to that because I haven't studied it. But when I hear doomsday analysis about anything, my antenna goes up because I think it's an opportunity.
I think this is a really good topic to explore in another call with each other, Sean.
Yeah, that would be fun. That would be fun. I'll do a little research on AI for it. I'll use AI to assess AI. Well, one thing we talk about is, we do laugh a lot. I mean, we're under stress. You're in the business, and this is where that emotional quotient is. There's IQ, EQ, SQ, and that EQ is really important. And to laugh and to have that humility, and I'll use AI to study AI is kind of funny, but it's also truth. All good humor has truth in it. So we do laugh a lot. Work is supposed to be fun, and we try to keep it that way.
I totally agree. I think the process is always the fun. I mean, if you're not having fun while you're accomplishing the goal with the team, then why are you doing it? Because once you're there, then it's done.
That's right. When people are happy and laughing, more gets done. They work harder. They feel appreciated, and there's just more trust and togetherness, right? You see it in all sorts of organizations that way.
Yeah. So to close off our amazing conversation, would you like to share something maybe more you have on your mind, or I don't know?
Well, I spent a lot of time.
Tell me.
I migrated away from we family offices and wealth managers. They are our clients now. I used to be the head of multifamily office, and then big trust company, and the thing that is really important is that I feel like the way most people made their money is usually in one company, their own company, right? And they build it up, and it's or they were part in at an early stage, and they built this wealth, and then it's sold, and they want to diversify, and that's fine. I think that's smart, and I think diversification is really a key to successful portfolio. Over diversification is where mediocrity comes in. And a lot of managers out there, you don't have to be a cowboy. You don't have to go out there and swing for the fences, but you also don't need to have hundreds and hundreds of holdings, because if you have that, you're going to have all sorts of, you may have some winners, you're going to have a lot of average, you're going to have a lot of failures. And what I'm getting at is failures take all the time. If you are, and you got to admit a mistake and
Mm.
move on. And I can tell you stories where I can't, and everyone who's honest and has that humility I talk about has mistakes. And it's interesting how, one kind of approaches these things where and I call it, if you're not sleeping easy at night, meaning the wealth manager, right? Or, when I was wealth manager, then I probably shouldn't be in that investment, right? And I remember I did that with a big auto company back in the 90s and wasn't sleeping well at night. And I reassessed it, wrote a letter to the clients, and we only held it for a couple months, and we were long-term investors. And I told them why. And I got more phone calls and compliments for admitting that. And I don't even think we took a loss. But anyway, sleeping easy at night is an important thing. And I think over diversification is a real problem.
Yes, I think that's a very good advice. And also being honest to your clients and not over diversifying.
Everyone appreciates truth, right? And honesty. And look, no one's perfect. And if you have a portfolio, my favorite portfolios I've told you in the past are, less than 20 stocks, right? And then maybe some real estate holdings or some alternative investments. But with that said, these portfolio managers who have 200, 300 stocks in their portfolio, they don't know what they do. And it's just kind of, you're just going to be average. That's all you're going to be, right? And their clients are not average. Their clients are exceptional because they built these exceptional companies and attained this great wealth, and so they deserve that type of thinking behind their money.
I think that those are very wise words to close off. That working for the best and then being the expert in certain niches only.
Yeah.
So don't invest in everything.
Don't invest in everything because everything's not great. And
true.
Cut your losers and keep your winners. That's the biggest thing. We would have things in our portfolio that would be 12, 13, 14%. And you know why? They were exceptional, right? So, we had discipline in terms of selling, but in certain conditions. But yeah, hang on to those winners because they're winners. Thanks so much, Kirsten. And then we'll talk soon, okay?